Welcome to our channel, Stock Market Analyst. Today, we're diving into the basics of margin trading. By the end of this video, you'll have a clear understanding of what margin trading is, how it works, and the risks and rewards involved. Don't forget to like, subscribe, and hit the bell icon for more investing tips. What is margin trading? Let's start with the basics. Margin trading is a strategy where investors borrow money from a broker to buy more stocks than they could with their own cash. This borrowed money is called margin, and it allows investors to leverage their investments, potentially increasing their returns. Think of it as using a loan to buy more shares. How does margin trading work? Here's how margin trading works. 1. Open a margin account. To start margin trading, you need to open a margin account with your broker. This account allows you to borrow money to buy stocks. 2. Deposit initial margin. You must deposit an initial margin, which is a percentage of the total investment. For example, if you want to buy $10,000 worth of stocks and the initial margin requirement is 50%, you need to deposit $5,000. 3. Borrow funds. The broker lends you the remaining $5,000 to complete the purchase. 4. Buy stocks. You use the combined funds, your $5,000 and the borrowed $5,000, to buy $10,000 worth of stocks. 5. Pay interest. You must pay interest on the borrowed funds. The interest rate varies depending on the broker and market conditions. 6. Repay the loan. When you sell the stocks, you repay the borrowed funds and keep any profits. Rewards of margin trading. Margin trading offers several potential rewards. 1. Increased buying power. By borrowing money, you can buy more stocks than you could with your own cash, potentially increasing your returns. 2. Leverage. Margin trading allows you to leverage your investments, amplifying your gains if the stock price rises. 3. Diversification. With more buying power, you can diversify your portfolio by investing in a wider range of stocks. 4. Short-term opportunities. Margin trading can be useful for taking advantage of short-term market opportunities, such as price fluctuations or earnings announcements. Risks of margin trading. While margin trading offers potential rewards, it also comes with significant risks. 1. Increased losses. Just as leverage can amplify gains, it can also amplify losses. If the stock price falls, you could lose more than your initial investment. 2. Margin calls. If the value of your account falls below a certain level, your broker may issue a margin call, requiring you to deposit additional funds or sell stocks to cover the loan. Failing to meet a margin call can result in the broker selling your stocks at a loss. 3. Interest costs. You must pay interest on the borrowed funds, which can add up over time and reduce your overall returns. 4. Market volatility. Margin trading is particularly risky in volatile markets, where stock prices can fluctuate rapidly. This can lead to unexpected losses and margin calls. How to manage risks in margin trading. Managing risks is crucial when margin trading. Here are some strategies to help you manage risks. 1. Set stop-loss orders. Use stop-loss orders to automatically sell stocks if the price falls to a certain level. This can help limit your losses. 2. Monitor your account. Regularly monitor your margin account to ensure you meet margin requirements and avoid margin calls. 3. Diversify your portfolio. Diversify your investments to spread risk across different stocks and sectors. 4. Use margin sparingly. Avoid using too much margin. Borrow only what you can afford to repay, and consider using margin for short-term opportunities rather than long-term investments. 5. Stay informed. Keep up with market news and trends to make informed decisions and anticipate potential risks. Practical example. Let's look at a practical example. Suppose an investor wants to buy $20,000 worth of stocks but only has $10,000 in cash. They open a margin account and borrow $10,000 from their broker. If the stock price rises by 20%, the investor's total investment is now worth $24,000. After repaying the $10,000 loan and interest, the investor keeps the remaining profit. However, if the stock price falls by 20%, the investment is now worth $16,000. The investor still owes $10,000 plus interest, resulting in a significant loss. To sum up, margin trading allows investors to borrow money to buy more stocks, potentially increasing their returns. However, it also comes with significant risks, including increased losses, margin calls, interest costs, and market volatility. By managing risks through strategies like setting stop-loss orders, monitoring your account, diversifying your portfolio, using margin sparingly, and staying informed, you can make more informed decisions about margin trading. That's a wrap on our guide to the risks and rewards of margin trading. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and share it with your friends. Have any questions or topics you'd like us to cover? Drop them in the comments below. Happy investing!